It's always a joy. It's always a joy to hold these webinars and to interact with you. So today we'll be talking about accessing retirement benefits. And we have been, if you are new and you're joining us for the first time, as introduced, my name is Rose Wakiria. I'm a financial and retirement planner. And basically what that means is that I work with individuals and couples to make the most of their financial resources. So I help them plan their financial resources so that they can be able to afford the life that they want to lead. And I also help people to prepare well for retirement, being the last and potentially the longest transition you're likely to encounter. And so we've been talking about retirement planning for a couple of years now, about 2 years. And we've been talking a lot about saving for retirement. So I want to believe most of you, if not all of you, are doing a good job about it. We've explored the different options, how you can plan for your retirement, how you can invest for your retirement. And I know a large number of people who attend my webinars are professionals, people who are in employment, and many of them are saving towards their retirement, primarily through retirement benefit scheme. So today we will talk about how you can access your retirement benefits in a manner that you'll make the most out of them. Because some people actually do a good job saving and investing, but when they access their retirement benefits, they don't make the most of them. A number of people I've even worked with admit that if I knew, I would have made a different decision. Now, accessing retirement benefits, it's such a critical point in our financial management, in the sense that majority of us are accessing retirement benefits while we are coming to the tail end of our career. So we might want to continue being gainfully engaged, but it's not guaranteed that we'll have those opportunities. So for some people, these are lifelong savings that they have saved over a very long time, and making a mistake at this point can be a very expensive mistake. You don't have much time to recover from this mistake. We are not saying all is lost. We know there are people who've had other careers after retirement and they've done very well, but for majority of people, this is likely to be the largest financial decision they are going to make. So this makes it a very, very important decision. Now, many people, when they're saving through retirement benefit schemes, they don't seem to know much about what is going on. And I see this because having been a member of retirement benefit schemes all through my career, it was interesting to see how very few people would attend AGMs. Even when I became a trustee, that was a very common issue. I have attended many AGMs, both from providers' perspectives, that is some of the insurance companies that provide these retirement benefits to the general public. But I've also been invited to speak at annual general meetings of many retirement benefit schemes. And the thing is that the attendance is usually very low. If a scheme makes 10% of members, that is a good turnout. So what happens is that we arrive at a point now when we want to access our retirement benefits to a large extent ill-equipped. Or at best, we probably have had what other people did, but that's what they did might not be what is ideal for our circumstances. So for that matter, it is very, very important that we take time to understand the implications, what happens at the point when you access retirement benefits, and how can you make the most of it? So we look at mainly two areas. We look at taxation and the effect on compounding. But before we get to that, it's good to redefine what retirement is. I decided I will be defining retirement every time we meet, because some people always ask me exactly what is retirement for me now that I have already left employment and I'm in my 40s. So am I retired or am I waiting to retire? So retirement is basically that transition whereby you live active engagement, where the income is a very big part of it, and you transition into other things. We don't retire to go and do nothing. We basically transition and start doing other activities, which probably might not have the opportunity or the potential to give us an income that would be adequate to fund our lifestyle. So in this season of life, we are depending on investment income on things that we had invested. And so now we are actually utilizing those investments. So this retirement then can come at any age and for various reasons. So for instance, you can leave employment because of you're sacked. You could lose your job for various reasons. You could resign because maybe the working environment is not good, or you can't be able to work in that particular organization. You could be retrenched. An organization could be downsizing, and so they are laying people off. You could also be unwell such that the employer retires you early on medical ground. It could be a normal retirement age, or you could reach 50 and you say, now that I've reached this age, I want to slow down a bit and I don't want to continue working. So you can either withdraw. Withdraw is basically when you leave employment, and by virtue of leaving that employment, you can access some of your retirement benefits before retirement age. That is before age 50, which is the early retirement age. We call that withdrawal, unless you're doing that because of a medical condition. And then retirement is when you leave the scheme from age 50 and above. We call that the retirement. It could be an early retirement, it could be a normal retirement, it could also be a late retirement, where you live on your benefits even after the normal retirement age. But medical, being retired on medical grounds can happen before age 50 or even after age 50. So it's important to recognize that. So when we're talking about retirement benefits, it's good to maybe introduce what products are we talking about. Now, going forward, and especially now with the implementation of the NSSF Act 2013, most people will definitely have retirement benefits. Previously, only those who are in formal employment mainly saved through retirement benefits, but now NSSF is supposed to cover everyone, including your house girl, your driver, your gardener, the people you've employed in the village. We are supposed to be helping them prepare for retirement. So everyone will have to make these decisions at the point when they want to access. And then some, of course, organizations have retirement benefit schemes. And we expect more employers to move in that direction, because as the contribution to NSSF increase, people can opt out of the NSSF using the Tier 2 contributions. And many people would want to put that in a private scheme other than the government NSSF scheme. So many people will be having multiple decisions. You have to make decisions on your NSSF, and you also have to make decisions on your retirement benefit schemes. However, there's also a category of people who normally have what we call gratuity. That is, the employer doesn't have a retirement benefits plan, and even now they might still want to continue, only contribute what is mandatory to NSSF, but continue giving their employees a gratuity scheme. Now, a gratuity, we normally call it a gift. It's something an employer decides to give an employee who is leaving organization, or they promise even at the point of engaging, which is basically intended to be sort of to prepare for retirement. You'll make your own arrangements to prepare for retirement. So we'll also consider gratuities, because they are also a form of retirement planning. But basically now, there are those three areas we would call retirement benefits: the NSSF, the gratuity schemes, and the retirement benefit schemes, which are both employer-sponsored as well as the individual schemes. So let's talk about gratuity scheme, and I will project the screen so that we can see some of the things I would want to share, or rather for you to see. I hope you can see it well. So gratuity schemes are normally offered by organizations that normally do not have retirement benefit schemes, but also sometimes they are offered to a category of employees, especially those in senior management who are employed on contract. So you're not employed on permanent and pensionable terms, so they decide to give you a gratuity if you serve the term. Now, gratuity is normally for a fixed period of time. The most in the market I've interacted with are 3-year schemes or 2-year schemes or 5-year scheme, depending on the contract the person has. And they tend to be based on a percentage of the salary. So Some organizations are very generous. They could give 31% of your annual income. Others can give 15% of your income. There is no really law that governs that. It depends with what an employer is willing to give. So when you promise an employee, it is expected that you'll give them. But if the employer does not have the money, there is nothing an employee can do. For example, if they get out of business because of poor economic performance, then so it's not protected as such compared to retirement benefit scheme. So many people usually have those gratuity schemes, so they keep renewing their contract. Somebody can work for an organization even for 20 years, but they had several contracts which they kept on renewing. So after every end of the term, they get their gratuity, and that gratuity is normally taxed at 30%. Basically, it's just added to your income that month, and then the taxation are applied. So for majority of people, you're basically paying tax on the gratuity at the highest tax bracket, which is 30%. Now, and this happens when you access that money. If you wanted to pay it to yourself, you'll pay 30% on the whole amount. So if your gratuity is 5 million, 1.5 million will actually go into tax, and then you'll be left with 3.5 to decide what you want to do with it. However, there are options. There are things you can actually do to minimize that tax, so that you're able to make the most out of your gratuity. So the law allows for you to transfer out of that gratuity 240,000 Kenya shillings per year of gratuity, tax-free, to a retirement benefit scheme. So it assumes that this was sort of your contribution. Those who are members of retirement benefit schemes can contribute up to 20,000 shillings per month tax-free, or up to a third of your income. So we assume you can actually make the 20,000 shillings per month. So it sort of makes that assumption. So you can actually backdate up to 5 years. So if your gratuity is maturing this year, you can actually backdate for the last 5 years, and you transfer that money without accessing it. It leaves the employer, and it is transferred directly to an individual retirement plan scheme, or if you are a member, you're joining another organization that has a retirement benefit scheme, you can actually do that. So you're going to save tax on that amount, which is basically 1.2 million. And so when that money now is in a retirement benefit scheme, it will continue growing. Like we've been talking about, the pension schemes declare an interest rate every year. And since these will be what we call registered benefits for tax purposes, or the tax-free contributions, then that amount will continue to grow on the full rate that is declared. Now, if you want to access the balance, it will definitely be taxed. And even if you want to transfer the balance, it will still be taxed, because the tax benefit is only for up to 20,000 shillings. So once the 1.2 million is exempt from tax, the rest will be taxed anyway. So what do you do with that money? Many people will use that money for various uses. They will invest. Sometimes they can do anything. They can choose to use it for consumption or whatever it is. But what we encourage people is to ensure or to plan to use this money specifically for retirement. So there are various products that you can use that would ensure that that investment is dedicated for retirement. Because, for example, if you buy a piece of land, yes, you can keep it for retirement, but I believe if something else comes up, another need comes up, you can still sell and actually meet that need. But then that will leave you not very well prepared for retirement. So today we'll focus on personal pension plan, deferred annuities, and treasury bonds. So you can actually use the balance now, which is taxed, to buy a deferred annuity. And even if your gratuity has come today when you're 35 or when you're 40, you can actually defer access of that benefit until age 60, if that's when you want to retire. What that does is that it gives you plenty of time for your money to grow. And most likely, probably, you're still continuing working with that organization, or you've gotten another job. So for majority of people, they won't need that money. You can also take that money and invest it in bonds. And if you invest it in bond, look for very long-term bonds that are in the market. I know you can get a 25-year bond and beyond. And then when you start receiving the interest every 6 months, have a plan to invest that interest. so that it continues to build on your retirement fund. Otherwise, when you invest in a treasury bond, the principal does not grow. The capital you invested remains. So if you invest 1 million, even after 25 years, you'll get back 1 million. But if you, for example, have now an individual retirement plan where when this money comes, you invest it there, then you could still continue growing your retirement fund. And of course, the other alternative is to transfer all the money to a retirement benefit scheme. So the bulk of the money will go into the unregistered fund. Unregistered fund is that component of your savings that has already been taxed. And the investment income is normally 30%. I mean, there is usually an annual tax on investment income, which is at 30%, which means that your savings, that component of savings will be growing at a lower rate. Now, when I rank these three options, I would encourage someone to do a deferred annuity. It's the best in the sense that it's dedicated for retirement. You'll even know how much money you'll be receiving from that investment from the outside, because when the insurance company does a quotation for you, it will actually give you the amount of money you'll be receiving every month in retirement. Treasury bonds would require that you be disciplined and you use the interest income very well, you invest it wisely so that it also serves the intended purpose. The income from those two, deferred annuity, since the money will have already been taxed, the income you receive will not be paying any tax. For treasury bonds, they will tax, they'll apply withholding tax on the interest. By the time you receive your interest, they'll be already taxed. Now, for pension plans, this presents the lowest your funds are likely to grow. So this is an option you can exercise. If you don't think you're very disciplined, then you can take it. It's better to earn a small return than no return at all. So I would encourage those who feel like they will divert the money to other uses, or by the time they retire, it will not even be there, they can do that. But it's the one that would probably earn the least. So the best thing would be to do a deferred annuity. You can also do the product we call income drawdown, which is an alternative to an annuity where you reinvest that money in a retirement benefit scheme. But again, it will also encounter the same issues as pension plan. So how would I best use my gratuity? If I want to use that gratuity for retirement, then I would put it either in treasury bonds or in deferred annuities. And those would ensure that the money is dedicated for that. So let me demonstrate, for example, the issue of taxation, and then we demonstrate what would happen for this particular client if they invested the money in a deferred annuity, or they invested the money in a pension plan, or even in a bond. So we'll assume a 40-year-old person who is receiving this gratuity. So the annual salary is 3.6, which is basically 300,000 shillings per month. And the employer's rate for gratuity is based on the salary. It is 25%, and their contract is 5 years. So at the end of the 5 year, the contract amount, at the end of the 5 year, the gratuity amount due is 4.5 million. So if this person decides on minimizing their taxation, then what they should do is to transfer the 240,000 shillings for 5 years, which is allowed in law, into a registered retirement benefits plan. And then the rest of the money will be taxed. And then, so this is how it shows. So gratuity is usually calculated per year. So the 4.5 million, basically it's 900,000 shillings per year. You deduct the 240 per year, which will go to a registered pension plan, and then you're left with 660 per year, which is taxable. You apply a rate of 30%, you will pay close to 200,000, and then you'll be left with an after-tax benefit of 462,000 per year and a total of 2.31. So at the end of that month, when your gratuity is being paid, you will receive, if you choose this option of putting the 240,000 per year in a pension plan, you receive an amount of 2.31. And so with that, now you can decide what you want to do. If you choose to receive all your gratuity in cash, then you will pay tax on the 4.5. So I can calculate that for you. Or if you have a mathematician, they can do that. You'll pay 1.35 million in tax. if you choose to cash out all your gratuity, you will pay 1.35 million in tax. So that's an additional of about 360,000 that you'll pay to KRA, money you don't have to pay to KRA. So we are going to use now this amount to demonstrate what you do with it, because the 1.2 is already in a retirement benefit schemes, the options that you can actually apply on the 2.3. So one of the options I talked about is buying a bond. Now, when it comes to buying a bond, you buy bonds in multiples of 100 shillings. So you can't buy bonds worth 2.31. That 10,000, you'll probably use it for something else or wait until it grows. This year, we've enjoyed very good rates for bonds. So many of the bonds have been fetching this rate of 13.5, the long-term bonds. Here I'm demonstrating with a 20-year bond. So the interest rate that you'll earn on that bond for 20 years is 13.5 on the principal amount 2.3. The withholding tax being 10%, it means on an annual basis, you'll be receiving an interest of 279,450 every year. And this amount comes in 2 installments. So half of it will come after 6 months and the other one after 6 months. So for 20 years, every 6 months, you're actually getting this amount. Now, you can compare this investment with other investments. Some people say, I'll use this money and I will go buy a piece of land, or I'll use this money and I'll go clear my debts, or I'll use this and furnish my house or something like that. So a treasury bond will serve many purposes. It can help you in case you have liquidity issues. For example, if you have children in high school or in school and you really need the cash, you can actually use half of the amount and say, I'll use half to pay school fees and the other one will go towards preparing for retirement. So it becomes a little bit flexible. So in 20 years, you'll actually have received a total of 5.5 million in interest. Only that it will be coming in various amount, in small amounts every 6 months. So if you reinvest this amount as it comes, the 279 as it comes, if you reinvest it, at the end, by the time you're age 60, you'll have accumulated a fund of 16.851 million. And when we do quotations based on the current annuity rates, that can fetch you an income of 227,000 per annum. That would be before tax. And then after tax, it would be 185,000. Now, actually, I need to eliminate the issue of tax because, no, there is tax because part of it would go towards registered component, the contributions, the 279,000, part of it you can contribute, most of it actually will go as registered pension, because if your employer doesn't have a retirement benefit scheme and this interest is coming, then you can actually send it there. So a component of it will be tax-free contributions, and so that is why there's a tax element. But you notice that the amount of tax you pay is quite small. So you can imagine for an employee who is working on contract for a very long time, they worked the first 5 years, they got their gratuity and they put it here, and then they decided after the next 5 years, of course, that time probably the amount will be higher. You can actually build a very, very high income for retirement, and you'll probably not use all the money to go towards retirement because you might have a target income. Maybe you want 300,000, 500,000, 1 million. It's not hard to actually build that income in retirement. But what is required is the discipline to put the money in the right place. So that is what a bond would do. And then after 20 years, you'd get back your 2.3. And that time now you'd be in retirement. Hopefully you'd be able to get another investment option that would give you a good return. But even if you don't, you've already secured an income that is quite reasonable. There are not so many people who retire on this kind of income from my experience, not very many people. So that is one option. The lump sum you received that was already taxed, you can actually put it in a treasury bond. The other option would be to use that same amount and buy what we call a deferred annuity. So a deferred annuity basically is you take your money to an insurance company and they invest it for 20 years. We are assuming this person is 40 years. And then they will start paying you an income at age 60. So based on the current rates, the quotations I have done this week for my clients, if somebody is investing 2.3 million for 20 years, at age 60, that will have grown to 22 million. And again, the insurance company's quotation for the income will be 265,000 shillings per month. And since this money was already taxed, then this income is not subject to tax. So this is a passive way. You just put your money there and you don't need to do anything. You don't need to manage anything like with bonds. For bonds to get that result, you need to manage the interest as it comes. But this one is a passive investment. Once you liaise with the insurance company, you set up your policy, there's nothing more you need to do. And you just wait for that period. So you can imagine, like again, I said, if every 5 years you're getting your amount, then you can keep on buying different deferred annuities. So after 5 years, you'll get another amount you can choose to defer for 15 years. Now, here I've only demonstrated what happens to the deferred annuity. But remember, there's some money we left in an individual pension plan if you chose to take the 240,000 into the pension plan. So your income would actually be much, much more. And you can choose this will be an income, and the rest as it grows, eventually you can choose to access it as a lump sum. So that is option number 2. And the other option, of course, is using that 2.3. Remember, no, in this case, we would be using all the money. Let me just go back to this. So if, for example, when your gratuity comes, you choose to actually use it, to invest it in a pension plan. That is the option. So we are talking about this 1.2 and 2.3, and that's how I'm getting 3.51. So you can choose to put that money in a pension plan and do nothing. You don't contribute after that. You just leave the money in the pension plan for the next 20 years. So you don't access it, just leave it, don't contribute anything else. In 20 years, using an assumed rate of 10% year on year, that money will have grown to 17 million. And that can fetch you an income of about 229,375 per month for the rest of your life, but guaranteed for a minimum of 10 years. And since some of it is under registered, remember the 1.2, you've already put it under registered, part of it you'll need to pay tax, and when calculated tax, you'd be receiving a net income of 225,000 shillings. So that is what you can do with your gratuity. Now, if you compare the three, we've talked of deferred annuity, we've talked of bonds, we've talked of personal pension. Let's look at what could go wrong, or what are the disadvantages of those investments. So starting with a bond, as I have mentioned, a bond, you will know the return. That one is predetermined. Once you invest in it, you'll know the return that you're investing for, and you can actually calculate your benefits. The challenge with bonds will be how you manage the interest as it comes every 6 months. If you're not able to reinvest it, after 20 years, you'll find yourself only with the principal. So that is the challenge with bond. But the good thing about it is that should you run into challenges and you need that income, you can actually use part of the income to solve some of your financial issues if you have them. So it has its pros and cons. Deferred annuity is a very defined product. You already know what you'll get. You even know the income you'll get after tax if the taxes don't change. But the point is, it's so definite, so clear. But the main disadvantage with it is that even if you run into financial problems, there's nothing you can do about that product. You can't access your money. You can't negotiate with the insurance company. There's nothing you can do. So it's not liquid. It is specifically designed for retirement. So for that one, we encourage that by the time you take the deferred annuity, you should be able to know where, if you had an emergency, where you would be able to pay it from. But should death occur, your beneficiaries will receive the money. Now, for personal pension plan, what could go wrong? We've used an average rate of 10% to project the return. Now, that is an assumption. The markets might perform well or underperform. So if it underperforms, it might not give you the return as projected, but it could also do well if the investments are doing way better. The other advantage with a pension plan, especially since this will be your own plan, it's not tied to the employer, you will have options along the way. So should you need your money and after some years, you have a financial crisis, you can actually access part of that money. But the other thing about it is that if halfway you decide, now I want to shift to bonds, or I want to shift to deferred annuity, you have that flexibility that you are not likely to have had if it was not in a personal pension plan. So if you choose to take your gratuity into a retirement benefit scheme, I always encourage people, you'd rather have your own as opposed to putting the money in the employer scheme, because once it's in the employer scheme, you can't access it and you can't exercise any of these options until you leave employment. So each option has its pros and its cons. But if you want money dedicated for retirement, then a deferred annuity would serve that purpose. And I'm challenging people to challenge their employers and the trustees to actually allow people to use that option when possible, because it is the surest way the employer knows that you will not access those benefits until retirement, because you have locked those benefits until retirement. So even if you leave the employer earlier, there is no possibility of you accessing that money. So it's actually the surest way. And that is what would happen, especially when the parastatals were shifting from defined benefit schemes to defined contribution schemes. Most of them, what they did is to convert the member savings into what we call deferred annuities. So they sold that portfolio to an insurance company, and basically what they did is a deferred annuity. So I believe even for members within schemes, there is an opportunity if you discuss it with your trustees, and probably if you need to discuss with the Retirement Benefits Authority, it's an option. And one of the good things about it is that it locks for you a return, which you might not be able to enjoy in future. So depending on where you are, and let me put a disclaimer here, that is why I work with my clients and we go into details, because before we take any of this product, then we need to look at what else is going on and whether this is the most optimum way of planning for retirement. But the assumption I am making here as I talk about this option is that you have plans for taking care of your emergencies and your other goals, such as educating your kids, building a home, amongst other things. And so the money you have here is purely for retirement. So those are options you can exercise with a gratuity. But I also want you to think that those are options you can actually exercise with any other money that you have from any other source. So if you sell a property, you can actually choose to do any of this. If you have a business and it gives you a good profit, you can actually choose to do that. The source of money does not have to be retirement benefits. It could be any source of money to do that. Great. I hope we are together. If you have a question, please feel free to ask. I would be happy to respond at that point. Now, let's move on to pension plans. So where majority of us are, many of us are employed, and so we are members of what we call employer-sponsored retirement benefit schemes. And so once you're in that scheme, you're bound by certain rules, which are a little bit different from when you're in an individual retirement plan. So the employer contributes towards your retirement. And so some of the rules say that even if you left employment earlier than retirement, part of that fund needs to be for retirement. So the rules have been changing. There are times you'd access different percentages, but the current rules say that if you leave employment and you're in an employer-sponsored scheme and you have retirement benefits, and it's before retirement age, you can only access up to 50% of the funds in your account. Now, the rule says up to 50%. What I normally see most people do is access the maximum, which is 50%. Sometimes you don't need to access all that money. Sometimes maybe you've lost your job, you are not prepared for it. And so you definitely probably need the money and you don't have any other way of funding your expenses before you get another job. Yes, you could actually access part of your retirement benefits, but you don't have to access the maximum. Sometimes you just need a certain proportion. So what you need to realize is that anytime you access your money, you pay tax. So you need to only access what you need so that you don't pay too much money to KRA, because you have an option of avoiding that. So access before retirement, you can access your money as a lump sum, the up to 50% as a lump sum. But if you are now retiring from an employer-sponsored scheme, then it becomes very important to know what kind of a scheme are you in. So there are schemes which are known as pension schemes. A pension scheme allows you to access only a small part of it, again, up to a third. You don't have to access a third, it's up to a third of your accumulated savings. And then the balance has to come in form of an income. So at that point, you have to buy either an annuity, which could be an immediate annuity or a deferred annuity, or an income drawdown. Now, you can find out whether you're in a pension scheme by looking at your pension statements. It normally reads there. Most of them will show it's a pension scheme or a provident fund. If you're a member of a provident fund, then it means on retirement, you can actually access all your money as a lump sum after paying the applicable taxes. Again, one of the common mistakes that we see many people doing, the ones in a pension scheme, they choose to access the 1/3, whether they need it or not. Yet majority of people, especially the ones I've interacted, the retirees, they wish they accessed more of the money as an income as opposed to a lump sum. Because when you access as a lump sum, most people have the pressure to spend the money. They spend the money and now after that, they don't have anything. And probably the way they spent their money, it did not generate more income. Yet, if you access it as an income, your income will go up. And you access that income for the rest of your life if you take an annuity. The other challenge we see with people who retire from provident funds, you don't have to access your money as a lump sum. You also have that option of converting whatever proportion of the fund into an income. But many people first access their money and they pay a lot in taxes. And once you pay a lot in taxes, that is a loss you cannot recover. There's no way you can recover that money, even if you chose again to go and buy an income. So don't access all the money as a lump sum if one of your main goals is to actually generate your money from a retirement, to generate an income from the retirement benefits plan that you have. So just because a limit is set and it's a high limit, it doesn't mean you need to access up to the maximum. You can access any amount. If all you need is 100,000 and your fund is 10 million, just access 100,000 because you'll only pay tax on that particular amount. Now, I think most of the mistakes are normally made by those who access their benefits before retirement, because if you access your money before the early retirement age of 50, you can actually and it's your own individual plan. Actually, if it's your own individual plan, you can access the money, all the money before age 50, whether it's a pension or a provident fund, because there is no employer component that is being protected. So we keep seeing people who build up savings and then they access them and then they say they'll start again, but it's not exactly the same. So again, if your plan is a pension plan, after the age of 50, which is the early retirement age, you can only access up to a third as a lump sum and the balance has to buy an income. And again, as a provident fund, you can access all of it as a lump sum. Now, majority of people prefer working with lump sums, yet we know majority of people have not handled those kind of lump sums before, and many of them tend to not make very good decisions. A few make good decisions, those who already have a plan on how that money will sustain them for the rest of their lives. But we encourage people to take more of a pension as opposed to a lump sum. First, you save on taxes, and again, you are able to provide for your needs. So let's look at withdrawal. If you're accessing your money before retirement, so basically you're resigning or you've been fired, there's retrenchment, or you have even chose to immigrate to another country which is outside the East Africa community, then you have options. You don't have to access your money immediately. You can actually leave your benefits in the same scheme until later or until retirement. You can transfer those benefits. If you've joined another organization that has a retirement benefit scheme, you can transfer there, or you can set up your own individual plan. And that's where people like us and other people who help people to set up individual plans, we come in, we can help you identify a provider and you transfer your money there. And like I said, when it's in an individual plan, you have more flexibility on what you can do with those benefits compared to when you transfer to another employer or you leave it in the same scheme. But when you're accessing, there are other ways you can maximize on your retirement benefits. For example, if you must access your benefits before retirement, you need to check with your administrator whether you can access what we call the unregistered funds first. Now, why is this important? The unregistered funds, you saved that money after tax, and that money, the income from that component was taxed on an annual basis. So at the point of accessing that money, you don't pay further tax. So if your administrator is able to pay you from that component, then it's better than accessing part from unregistered and part from registered, because what comes from registered has to be taxed. And so once you receive the unregistered component, since you're not paying any tax, then you'd be able to go and invest in other things, or if you really need to use the money, you can actually do that. So some of the ways we've said, you can put in bonds, you can put in deferred annuities. If you have a mortgage and if you have an outstanding balance, especially if that is going to be your retirement home, you can consider paying off your mortgage, and you can also put that money into other investments. And I have put a star. I'm hoping that you'll make good investments that will provide for you in retirement. So the fact that you're leaving an employer, you don't have to access the money just because it's accessible. There are options, and whatever option you choose, you need to look at the one that will favor you, but also where you will minimize on the tax amounts that you're going to pay. And that is somebody leaving early. What about those who are retiring? And this retirement could be any age due to medical grounds, or you are now 50 years and above, or it's your normal retirement age, or you have even worked after your retirement age. So from 50, it's called retirement. So many people feel like they have to move their money immediately. No, you don't have to. The law allows you to leave your money in your scheme even after you have retired for up to 12 months. And that is to give you time to explore, to think through what you need to do, to look for the suitable solutions. You don't have to access your money immediately. However, for those who are in segregated funds, that is schemes where capital is not guaranteed, return is not guaranteed, I normally encourage them that you need to be very, very careful, because there is a possibility of you losing part of your capital if the investment returns are not so good. So let me give you an example. If you retired in 2021, and the returns in 2021 were better than 2020. 2020, it was a COVID year, but 2021 was a recovery year. But 2022 was a more difficult year than 2021. So if you retired, for example, December 2021, and you dilly-dallied or you didn't take your money immediately, what happened is that many schemes in the segregated environment got very low returns or even negative returns in 2022. There is a survey that was done on those schemes outside the insurance industry, and the average return for about 400 schemes, it was 1.7% for the year 2022. That means many of them made a negative return or a very low return. It may not be very low, but the point is it's 1%, 2%, negative 1%, something like that. So even in a segregated environment, it is good to look at how the trends are going. But to avoid loss of funds, you can make that decision at that point. Or if your scheme, depending on the kind of scheme that you are in, if it can allow you to transfer to now the guaranteed funds, at least you know you will not lose any money. Again, for such decisions, you might need to consult someone who will guide you on that. Talk to a retirement planner or somebody who is very well conversant with taxes. They will be able to help you with that. So you can either leave your fund there, or you can transfer to another scheme, especially for those who are in provident funds. Since you are allowed to access your money as a lump sum, it doesn't matter, any provider will allow you to transfer. If it is a pension scheme, they might want to ensure that you receive your money as an income, and they might put a few restrictions. But if you have a provident fund, you feel free to transfer, even in a segregated environment to a guaranteed environment. At least that way you are sure to protect your capital and your money will grow. And you can keep it there for as long as you want. You don't have to access the money if you have other sources of income. But if you retire early, for example, if your organization has an early retirement age of 55 years and you feel like you'll have enough money to sustain you for the next 5 years, you can choose to buy an annuity but not access the money immediately. but defer that annuity for about 5 years. Now, what happens is that you lock in a good return, which probably you would not have gotten from your pension scheme, and you also lock in the returns on the annuity, the amount of money that you'll be receiving. So your money grows, your capital grows, and I will demonstrate that. Your capital grows, and then your income will definitely be way higher in the next 5 years. But again, if you don't want to wait, you can actually buy an annuity immediately that starts paying your income there and then, or you can take the income drawdown product. Again, if you don't know about these two products, we've done webinars on them before. And I've also written a book where I have detailed these products. It's called Retirement Planning. You can also get information from our website. Steffi, maybe you can indicate the Retirement Solutions website. You can actually go and read a little bit more about these products. Right, so that's how you access, those are the access options in retirement benefits. So as we proceed, I have seen some 2 questions. I would want to see what they are and see if I can respond to them now. So Vero is saying, what about cases where the gratuity, the transfer of gratuity is monthly from the beginning of the contract, hence compounding of both the registered and the unregistered balance? I think if your employer is paying your gratuity on a monthly basis, I think that's a good thing because you have an opportunity to invest it. So if you're already using a retirement benefits plan, that is one of the options I was giving. Since again, it's your individual plan, you can accumulate your unregistered balance for some time. And then if you want to use it to buy a bond or you want to use it to buy a deferred annuity, you can actually exercise that option if the gratuity is being transferred to your own individual plan. But if it is being transferred to the employer plan, you realize that you cannot access it until the end of your contract. But if they're transferring it on a monthly basis, then you have more options. You can actually, in addition to the benefits I have demonstrated, during the 5 years when your gratuity is building up, your savings should actually be growing. I hope I've answered that. If not, you can reach out to me later. I can explain further. Lucy Karaoke is asking, if you happen to die and you have invested your benefits in an annuity, what happens to the money? So when you invest your money in an annuity, like any other financial product, you need to name your beneficiaries. So in event of death, those benefits now become payable to the beneficiaries. So if it is before the income starts, in case of a deferred annuity, that contract ends there and then, and they calculate what your principal is and what interest it has earned, and they use that money to pay your beneficiaries. If the income has already started, various companies have different ways. Some will continue paying an income up to the end of guarantee period, or some will actually calculate the amount due up to the end of guarantee period and pay it to your beneficiaries, of course, at a discounted rate, and they pay it to your beneficiaries as a lump sum. So you don't lose your money, even if you've invested in an annuity, as long as it's before the guarantee period. But if you had already lived beyond your guarantee period, the minute you die, then the contract will cease at that point. Right, Patricia is asking, how does one access their savings from NSSF after 50? Are there requirements? I encourage you to actually go to NSSF anytime. You don't have to wait until you're 50. Go and ask for your statement. It normally takes about 10, 15 minutes. One of my friends here in the office passed by NSSF the other day and she got her statement. Sometimes you'll find that there are gaps, there's certain contributions that are missing, and you'll just need to go back to your employer. In most cases, they have paid, but it's just a matter of providing proof that that was paid. The few clients who have accessed their retirement, their NSSF, my clients who've accessed their NSSF, most of them were very surprised at how efficient the process was. They did not struggle with the process. So the best thing is to visit a branch or the head office, and they will advise you on everything they need, but definitely they'll need your ID amongst other things because they need to confirm that you are already past 50. And if you are working, they need to realize, you need to provide proof that you have left employment. So either you have retired or you've been fired or you have resigned or whatever it is, then they will work on them, but they actually work more efficiently than many people expect. Regina Morioki is saying, please clarify the structured and unstructured bit of employment pension. I'm not sure if I got that right. Please clarify the structured and unstructured bit of employment pension. Or maybe Regina, you will try to explain, you can clarify that more, but just in case you're asking about the structured employment pension, I would think the employer pension is which has very defined structures, if that's what you're asking. So an employer will normally say, this is the contribution you're making, this is the contribution I'm making on your behalf, and then there are specific rules that you have to follow, which basically means you can't access your benefits while you're still working for that employer. And then even if you leave that employer, you cannot access, before retirement, you cannot access more than 50% of what has accumulated. Of course, the unstructured one, if that's what you mean, is the individual pension plan, which is a voluntary plan. You go and set it up and you set your own rules. Of course, there are some retirement benefits rules that are there regarding taxation and access to benefits, but that one you choose how much you're going to contribute, when you're going to contribute, when you want to access your benefits. It's a little bit more flexible. However, just in case you are talking about employment and self-employment, where employment is a structured way of saving for retirement, well, those who are in self-employment or business, if you're in employment, chances are you'll be in an employer scheme if they are providing one. But if you're in self-employment, then the ideal thing would be to set up your own individual retirement plan. And like I said, you'll get the most if you're contributing up to 20,000 and combine that with other investments. But if you're not disciplined very well, even if you have more than 20,000, then choose to put it there. It's better when it earns a smaller return and you're saving than when you're not saving at all. Again, Regina, if I've not answered your question, please feel free to clarify. So Phoebe is saying, my pension scheme has come up with an IDD as a retirement product. Yes, most schemes have that extension. Is it advisable to leave my money with my pension scheme or to buy a product from an insurance company, which I believe has enough experience? Again, it depends. There's some pension schemes that perform very well. There are many pension schemes that do not perform on average. So it depends with how your scheme is. If your scheme is performing well, fine, you can do that. There are some people who don't even have an option of buying from the market, because if you had a defined benefit component of your pension and your scheme provides the pension, you have to take the pension from your employer. But if you have a defined contribution component of your savings, then you're free to shop around. So I would say, if you're not sure, you can talk to us and we can help you evaluate and see whether leaving it with your employer is the best thing or working with an insurance company is the best thing. Of course, if you need an annuity and your scheme is not a defined benefit, you can only get that from insurance companies. So majority of people will use an insurance company for annuities because that's the only source if your scheme is not a defined benefit scheme. And what we know is that even many of defined benefit schemes, they decided to offload that to the insurance companies because the liability can become very excessive if the retirees live very, very long. So it depends, but to a large extent, insurance companies are more geared towards that. Bernice is saying, thank you for continuing to walk the journey of retirement with us. God bless. Thank you very much, Bernice. Kindly clarify the advantage of a bond and treasury bills as opposed to an annuity, which has no residual monies after defined period. So a bond is basically a principal. You take a principal to the government and you get to enjoy the interest over time. And then later, when the bond matures, you access your money. So that is the difference between bonds and annuities. Annuities will not have a residual amount unless the market can develop and actually structure such products. But for now, I'm not aware of any annuity that gives you a residual amount. So it depends with your particular circumstances. There's some people, all they want is an income to cover their expenses, and probably an annuity would be the best thing for them. But if having a principal at one point later in life is very, very important for you, then you can have a bond. So the other advantage of a bond is that it's liquid. You can sell it if you need to, but an annuity, you cannot sell it. You have to take the income as it was determined. So yes, in an ideal situation, remember, we normally talk about diversifying your investments, including your income in retirement. For majority of people, if they can, we like using a combination of all this, so that in future, should you need to liquidate some of your investment, you're able to do that. So it's not an either or. It's not like I can only do bonds or annuity. No. Ideal situation would be have some money in an annuity, have some money in a bond, have some money in other investments as well. The other question, okay, how much is the book? Retirement Planning, the book is 950. Steffi will provide the details shortly. Judy is asking, please clarify, if the deferred annuity is purchased with unregistered portion from the pension scheme, then even when one starts earning the annuity, will they pay tax? No. So when you buy a deferred annuity, what normally happens is that you must send a pension statement to the insurance company, because they need to know the money that they have received, what is registered component, that is the tax-free contributions, tax-free investment income, because that component, when you're receiving it, an income, and the unregistered component, which was already taxed when you're contributing, and the investment income was taxed, when you're receiving that money, that component is not taxed. So the insurance company will insist, can we have the pension statement? And then they are able to apply them in their systems, and you don't pay tax on the component that you had already paid tax. Now, this is where now we come and advise you. There are certain providers which will normally pay your income from the unregistered benefits, and there are some who normally take a slice of registered and unregistered. So there are also providers who will be more tax efficient than others. So we can advise you on that. But yes, money that you pay tax on, you don't pay, there's no double taxation. And how they ensure that is done is by you providing that statement. And they will not even proceed without that statement. So you must provide it. Phoebe is asking for recordings. We have those. Maybe Steffi, you can let them know where they can get those recordings. Marion is saying, thank you for the good work you're doing. Thank you, Marion, for your appreciation. Kindly tell what is the benchmark used to evaluate performance of pension schemes. So again, pension schemes, there are many ways you can look at their performance, but the one that is obvious is the return that they're giving. Every year, these pension schemes declare their rates. The ones in the segregated environment, they're actually able to tell per quarter. So a benchmark would be all these schemes are investing in the same market. Of course, some do some offshore. So you can compare what return they're giving. You can also compare how consistent are they. Do they consistently offer high returns, or are they a little bit volatile? You can look at the history. We normally don't look for at 1 year. We normally look at 5 to 10 years. That gives us a better picture. So that is one way we look at it. But performance is not everything. You also need to look at the management of that company. You also need to look at how is their service, because you can get good returns, but sometimes working with certain providers is such a pain that when you need your money, it might take you so long to get it. But the average way of comparing is looking at how did they perform compared to their peers. And for example, for the ones in the insurance industry, since they make their returns public, you're also able to get the average of the industry, and then you can compare whether they are performing above the industry or below the industry. If you'd be particularly interested in knowing what the schemes in the insurance industry have done in the last 10 years, you can send us an email and we'll be able to share with you. We have 5-year and 10-year comparison and the industry average. Joseph is asking, what happens if the insurance the insurance company you got your annuity from goes under. Now, we normally say that there is no investment that is risk-free. However, different investments put various mechanisms to secure clients' funds, and particularly retirement benefits. There's a lot of governance that is put around it because they want to ensure that since these are long-term investments, that they will be available to serve the clients when they are needed. So an annuity is an insurance contract. So when you give your money to the insurance company, the insurance company, they actually have what they call a life fund, which is a separate legal entity from the company. And so even if the company got